Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a required new fund formula. This time, we're going to be having the current assets and liabilities change relative to sales. It's going to be a little bit different than the prior problem. We worked with this in that we're adjusting the formula to be picking up the current assets as opposed to the total assets due to the fact that we're not at capacity when we're making our projection. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you'd like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 438 required new fund formula, current assets and current liabilities changed relative to sales tab in the practice problems section. Going to be closing this back out. We're going to go over our information up top, then we'll have a smaller caption of that information so we can use it to work through the practice problem. So we have the required new fund formula. We looked at a presentation on the required new fund formula in a prior presentation. This one will be a variation of it slightly. We want to understand what the formula is, how to plug the information into the formula, look at each of its components, and then think about how the formula could be varied depending on our circumstances, which is what we will do now, a slight variation, which you might see in practice and you might see in practice problems. So we have the expected increase in sales is going to be 40%. Fixed assets to remain the same. So in other words, we're not going to be changing the fixed assets this time as opposed to last time when we're thinking about everything varying with regards to an increase in the sales. Why might that be the case? Might be the case if we're not at capacity, right? We might be able to say, hey, look, the fixed assets that we have, we had a restaurant example kind of last time, right? If your restaurant isn't seating at capacity, then you can increase the amount of people, you can increase the sales without having to have more space, without having to have more fixed assets, without having to have another building, another building that you're going to need, right? So same with equipment or something like that you might be using. If you're not using that stuff to capacity, which could very well be the case, then we can assume that the fixed assets will remain the same, modify our formula to take that into consideration. Okay, so then we're going to say the current liability will vary with changes to sales, vary with sales change as well. So then we have our our income statement. We have the sales, expenses, and the operating income. I started to lose my voice there, but the coffee helped. Coffee helped. It's back. And that's going to give us our operating income, the interest, the earnings before taxes, earnings after taxes. This is for the period that has already passed, not the projected time period that we're going to be projecting out. We paid dividends in the period that already passed at the $12,180,000. Then we have the assets, including the current assets here, the fixed assets, total assets, liabilities, including the current liabilities, the notes payable total, which is the long-term liability. Then we have other long-term debt to give us the total liabilities here. Then we have the equity, and that's going to give us our total equity, and the equity and liabilities, of course, matching up then with our total assets. All right, then we're going to use the percent of sales method to see if external financing is needed. So here we have our information, breaking down that information once again to use. This is going to be our formula. So we have our formula here, and we'll be doing some comparison with it to our standard accounting equation. So the formula we have, we can break it down into basically three components here, and I would break it down in kind of like the asset component, the liability component, the equity component. We're thinking about an increase in the future, so we're thinking about an increase of the 40% in sales. What then will be the effect on the assets? How will the assets be increasing? Because we're saying that there will be an increase in assets, which you would expect, we're going to say, in the current assets, not in the total assets. So we're going to modify this portion of the formula, changing assets here, not really from total assets to current assets. If the assets then increase, we must finance that increase by either liabilities going up or equity going up. So that's why the formula is going to be assets minus the liabilities minus equity, meaning assets go up minus what's going to be financed by liabilities minus what's going to be financed by equity. If there's still a positive number, then we need more financing, right? Then that's going to be the required new financing. So we're going to have our breakout. We're going to take the assets over the sales in the current time period and then times the change in the sales that are going to be taking place. So we're looking at the ratio, and we're going to be changing this to current assets, which are going to change relative to sales, meaning you can imagine if the sales remained the same, then you would think our current assets would be sufficient to generate the same sales. But if we're going to have an increase in sales, we're going to say then the assets over the sales, current assets now over sales, is going to be the change that we're going to have times the change in sales, meaning the difference between the projected sales and the current sales, the increase that we're projecting. That's going to result in the assets, the change or increase in the assets, the change in the liabilities that will help to finance that are going to be the liabilities over the sales. You would expect then the liabilities to be increasing to some degree, especially the current liabilities, which is what we're going to change here, current liabilities over the sales, because the payables you would expect to increase with relation to the sales in general. So we're going to say liabilities over the sales times the change in sales, meaning the increase in the sales from 1 year to the next. And then we're going to say minus basically the equity portion, which is going to be the profit margin times the sales, which will give us basically net income, which would be the increase in equity, and then basically minus the amount of dividends that we're going to be paying out. So this third portion is going to be, in essence, net income increase, which is basically equity minus the portion of the net, the equity will increase by basically net income minus the amount of that net income we're going to pay out in the form of dividends. So if this ends up with a positive number, then we would need more financing. If we end up with a negative number, then you would think that we are okay. Now we weren't given the profit margin this time, but we can calculate the profit margin in the current time period. We can just say, all right, the income statement profit margin, we're going to be taking the net income, basically bottom line number, the 46,190 on the income statement. We're going to be dividing that by the sales top line of the income statement here. That's going to give us our profit margin of the 15.66. We may have to deal with some rounding. We will have rounding issues with this problem. So, and these are projections, so that's always going to be the case. We're looking for, rounding shouldn't bother us too much because we're looking for a projection into the future, not an exact number, because nothing's going to be exact when you're projecting into the future. So then we have the payout ratio. We can think about the payout ratio for the dividends. So to think about how much dividends we're going to pay, we can say, all right, the dividends we paid last time were the $12,180,000. If we compare that to the earnings after the sales, the $46,190, basically net income, dividends divided by the earnings mean we paid out 26.37% of the earnings in dividends. So we're going to assume in the future then that we're going to be paying out another 26.37 of whatever the net income is as dividends, and that the profit margin, we have the 15.66. Okay, so then we're going to have our formula. We have our required new funds then. We're going to look at the asset part of the formula first, and we're going to break this out in like a tax kind of format. You can obviously do it algebraically. I think it's useful to break this out in like a vertical, kind of like a tax return type of format, so we can analyze each component in this format. So we're going to take the assets that we're picking up from the balance sheet divided by sales. Now the assets we're modifying here to the current assets. So we're picking up the current assets, not picking up the fixed assets. We're going to assume the fixed assets remain the same, even though we expect an increase in the sales volume. So we're going to take the current assets divided by the sales. That's going to give us our subtotal, which I made a percent just so we could see more detail in the numbers. We're going to have rounding involved. 145,003,000 divided by 295,000,000. That gives us the 49.15. So, and I'm actually going to use this number to do the calculation here. So let's then say we got the change in the sales. So we got the sales for year 2. And we said that it's going to be increased by 40%, the sales number. So we're going to say, all right, sales is the top line of the income statement. It was at the 295. And we're going to say times 0.4 plus the 295 is the 413. Or we can say we have 100% or 1 plus the 40% or 0.4, 140% or 1.4 times 295. And that's going to give us the 413. So we got the 413, and we'll subtract that minus the sales for the current time period, which of course was the 295. That means the change, we're going to have an increase of the 118 million. So I'm going to recalculate this so I get more of the exact number. This was the 145,003,000 divided by the 295,000,000. That gives us this number, which is approximated here in percentage format, times the 118,000,000. that gives us then our increase in the assets of the 58,001,200. So that's going to be our increase in the assets. We're going to have to finance that increase in the assets that we're estimating based on increase in liabilities or equity. Liabilities and equity would then go up. Let's now focus on liabilities, which is going to be this component of our formula. So we're going to say, all right, second component of the formula. We've got the current liabilities. That's going to be here on the balance sheet. We're picking up not the total liabilities, but the current liabilities here, not including these long-term components. So we're taking up the 32,000,003. That's going to be this item. We're going to compare that then to the sales for year one, which we can compare to this item up top. So if we divide that out, we're going to say, all right, let's divide that out. We're going to have rounding once again. We got the 32,003,000 divided by the 295,000,000, and that's going to give us, if I make it a percent, the 10.85, or really this number. So then we're going to take that and multiply times the change in sales, which we calculated up top. Year two projected sales minus year one actual sales gives us the increase of the 118. Multiplying this times the 118,000,000. That's going to give us then increase in liabilities expected 12,801,200. So we have the increase in the assets that we think are going to be financed in part by the liabilities. Will the equity then take up the difference to finance the difference? Now we've got the profit margin times the sales for year two. And so and notice what that is. If we took got the projected sales for year two, which we calculated up top already. So projected sales for year two, 413,000,000 times the profit margin, 0.1566 about, and notice this number is rounded. So that's why we have a slightly different number here. In other words, if I took the profit margin up top, profit margin was the 46190,000 divided by the sales 295, and I get actually this number, which is approximated here, and I multiply that times the 413,000,000. We then are going to get the 64,666 here. That would be our net income. So that's going to be our net income. So normally you would think, all right, now I've got the net income, and you would subtract out basically the dividends. So the dividends. So dividend, I don't think it's spelled right. But you would then subtract out the dividends, right? And think about what the net increase would be. So if we were to think about it that way, we'd say, all right, we had the dividends that we calculated. Let's just do it again. Dividend ratio was 12,180,000. The dividends we paid out last year divided by the 46190. And so we're going to pay out about the 26%, right? Times the net income of the 64,666,000. That's going to give us our 1752. So the 1752 is how much we're going to pay out. That means we would keep the 64,666,000 minus the 17,052,000 we're going to pay out. That means there's going to be a net increase of the 47,614. So we're going to do that a little bit more succinctly over here by taking the net income, which is these two numbers again. Again, we'll have to deal with rounding, so it won't be exact here. But 413,000,000 times the 0.1566, that's going to give us the 64,675. And then instead of multiplying times, instead of subtracting out basically the dividends as we did over here, we're going to multiply times the portion we're going to keep, which would be 1 minus the dividend payout that we have, the dividend payout ratio, which is the 73.63 about. So we're going to say times the 0.7363 about, and that's going to give us about the 47,614. And again, it's the difference is due to rounding because these numbers are actually in Excel, the actual numbers. So you saw here that, you know, when we did the actual calculation of the actual number of the profit margin times the sales, we got to this number, the 64,666, and then this number, let's calculate that exactly here. We would say, okay, well, we have the dividends of the 12180,000 are divided by the 46,190,000. That's the dividends that we expect to pay out, minus 1. That's going to be our 73. So that's that 73.63 about. So it's 73.63 about. So now if I take this number and multiply it times this 64,666,000 times the 64,666,000, we're going to get the 47,614,000 more exactly due to having, these rounding issues. Okay, so that means that the assets increased by the 58,001,200 minus the liabilities 12,801,200 minus the increase in equity 47,614. That's going to give us a negative. So that means that we are covering the total assets, should be okay without additional financing, because the asset increase is going up, and we're covering that with the estimated increase in the liabilities and the equity.